Today, we're diving into the 50-year mortgage. Is it a financial lifeline or a long-term trap? Some see it as a crucial solution in an era of escalating prices and interest rates, offering a path to home ownership. Others caution against it, seeing it as a debt burden that accumulates excessive costs over its extended lifespan. The reality, particularly through the lens of real estate investing, reveals a more nuanced picture. A 50-year mortgage means the loan repayment period is stretched over half a century or 600 months. This extended term significantly reduces the monthly payment compared to traditional 30-year or 40-year mortgages. For many prospective homeowners, this reduction in monthly outlay makes the dream of owning a home more attainable. However, for real estate investors, this lower monthly cost transforms into a powerful strategic advantage. While monthly payments are lower, interest rates on 50-year mortgages are typically higher to compensate lenders for increased risk. The paramount benefit for investors is enhanced cash flow, critical for managing property finances. A 50-year term allows an investor to stabilize a property more comfortably, especially during initial years. This is crucial when unexpected expenses like repairs, vacancies, or renovations can significantly drain resources. The reduced monthly payment also frees up vital capital for property upgrades or building financial reserves. This flexibility enables investors to force appreciation, significantly increasing the property's value. In markets where property prices have outpaced average incomes, a 50-year mortgage can make previously unfeasible deals viable. This opens up investment opportunities in neighborhoods or cities once considered financially out of reach. Despite these advantages, the 50-year mortgage faces significant criticisms, primarily concerning the total interest paid. Stretching payments over 5 decades means you will pay substantially more in interest over the loan's lifetime. Equity also builds much more slowly, as the majority of early payments are allocated to interest rather than the principal. It can take almost 40 years to pay off just half of the original loan balance, leaving homeowners vulnerable to market downturns. Furthermore, the availability of 50-year mortgages is not universal. Not all lenders offer such extended terms. However, here's a crucial distinction. Most investors do not hold a single loan for the full 50 years. They typically refinance, reposition, execute a 1031 exchange, or sell the property long before maturity. Therefore, the 50 years of payments argument carries less weight for an investor than for a long-term homeowner. Investors prioritize immediate benefits, cash flow, flexibility, and the ability to acquire or improve assets efficiently. When viewed this way, a 50-year mortgage isn't a burden, it's a powerful financial tool. It can enhance property cash flow, alleviate month-to-month pressure during renovations, and unlock deals. As with all real estate ventures, the numbers ultimately dictate the strategy's success. In a market characterized by strained affordability and high interest rates, the 50-year mortgage offers investors a viable path forward. It enables them to continue acquiring properties and building wealth without being immediately overwhelmed by debt service. This strategic advantage can truly make all the difference in today's challenging real estate landscape. For investors, considering a 50-year mortgage with the intention of refinancing later can be a viable strategy. Making extra payments towards the principal can also accelerate equity building, mitigating one of the main drawbacks. It's essential to factor in long-term financial goals, such as retirement, when considering such an extended loan. The impact of 50-year mortgages on the housing market could be significant, potentially increasing demand by making home ownership more accessible. However, this could also lead to an increase in house prices, creating a complex dynamic. Lenders face increased risk due to the extended loan duration and uncertainty regarding repayment over 5 decades. This introduces more interest rate and prepayment risk, potentially leading to wider spreads and increased market volatility. If a 50-year mortgage isn't the right fit, investors have several alternatives to consider. These include shorter-term mortgages like 15-year or 30-year options, which build equity faster. Other alternatives are hard money loans for quick flips, private money lending, or seller financing. Home equity loans, REITs, lease options, partnerships, and crowdfunding also offer diverse investment avenues. Refinancing is a critical strategy for investors utilizing 50-year mortgages. If interest rates drop, refinancing can significantly reduce monthly payments, improving cash flow. Investors can also refinance to a shorter term, paying off the loan faster and saving on total interest. A cash-out refinance allows borrowing more than owed, receiving the difference in cash for other investments. Switching loan types, such as from an adjustable-rate mortgage to a fixed-rate mortgage, is another common refinancing strategy. Industry experts hold mixed opinions on 50-year mortgages. Some believe they can genuinely aid affordability and open doors for first-time buyers. Others express concerns about increased debt burdens and the potential for rising home prices. The trade offs, particularly slower equity building and higher interest costs, are significant considerations. In summary, for investors, cash flow and flexibility are paramount. Always be aware of the higher total interest paid over the loan's life. Having a clear exit strategy, whether refinancing or selling before maturity, is essential. Consider market conditions and the potential impact on home prices. The suitability of a 50-year mortgage depends heavily on individual financial circumstances and investment goals. Finally, always consult with mortgage professionals and financial advisors before making such a significant decision.